Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the podcast. I am DJ Cheong, investment strategist, and on this episode of the podcast, we'll be discussing the implications of the recent surge in U.S. Treasury yields on a number of asset classes. Joining me for this conversation today are Manpreet Gill, Head of Fixed Income, Currencies and Commodities, and Abhilash Narayan, Senior Investment Strategist. Abhilash, my first question is for you. The topic of the week has really been about the recent surge in yields. In your view, are U.S. Treasury yields a threat to riskier bonds?
Thank you, DJ. And yes, we have seen 10-year Treasury yields increase by nearly 0.4% since start of the year to about 1.3% right now, as markets have brought forward the expected end date of easy Fed policy amid improving growth and inflation expectations. However, in the recent FOMC meeting minutes, Fed officials reaffirmed their commitment to easy monetary policy, and hence we believe that the Fed will aim to limit any significant rise in yields from here on. If we look at technical charts, 1.283 is a key resistance level, which has been broken for now, but if yields fall below that, then they could very quickly move to the next support, which is around 1.18%. Now, overall, the rise in Treasury yields due to improved growth prospects is actually supportive for our bullish view on corporate as well as emerging market bonds. And hence, we continue to like developed market high-yield corporate bonds, emerging market dollar, and Asian dollar bonds. And the current weakness can actually be used as an opportunity to add exposure to these areas.
Thank you for your thoughts, Abhilash. If I look at recent moves, they kind of remind me of what we saw in 2018, where higher yields started impacting U.S. equities. In your view, how should equity investors position for rising U.S. Treasury yields?
Thanks, DJ. Now, if you look at the market performance, the rise in 10-year Treasury yields has fueled a strong performance of value-style stocks. If we look at what's happened in the past few days, the return in concerns about inflation has meant that the narrative has shifted from a reflationary environment where most stocks would benefit to a rotation narrative where we can see strong performance for selective areas. Additionally, if we look at the slowdown in market volumes, which indicates lack of fresh liquidity, that would indicate that a rotation from growth into value stocks is becoming more likely. Thus, we believe that value sectors such as financials, materials, industrials, and energy are looking increasingly attractive. Now, of course, these are the sectors that suffered biggest decline in earnings in 2020, but we think are likely to deliver the biggest rebound in earnings in 2021.
Jumping over to you, Manpreet, do you think the dollar can benefit in an environment of rising U.S. yields?
Hi, DJ. Yes, that's very possible. I think over the past few weeks, one of our big focuses has been on the risk of a corrective rebound higher in the US dollar. And higher yields absolutely, are one trigger that could sort of help that process along. The other, of course, is, quite excessive or still excessive short positioning in the dollar. And I think it's important here to focus on the euro-dollar pair in particular, because one is, of course, it tends to be treated as the default, anti-dollar currency, so to speak, but it's also where the point of positioning is most extreme. So we are looking for, in the short term at least, potential retest of the 1.195 level, and if we do get a break of that, maybe even going down to 1.189. I would emphasize, though, that this is a short-term view. I think long-term, we still expect dollar weakness to resume. So within that corrective rebound are, of course, quite normal. And I think, look, the fact that, we do expect the Fed to, not allow for a runaway rise in yields, particularly net of inflation terms, and we still have large deficits in the dollar. So we do think, both of those come together to make the case for, USD weakness to resume, even if we get a corrective rebound in the short term. So going back to the euro-dollar, for example, we sort of set out those levels on the downside, but if we do see a break back up above 1.22, that could signal that the dollar weakness trend is resuming. And of course, if we do see that process come along, it wouldn't be just about the euro. We also think the pound sterling and the Aussie dollar will be our two other beneficiaries of a resumption of dollar weakness.
Thanks, Manpreet. On this note, gold has also been struggling in recent days. Should investors start reducing exposure?
But I think it depends on your starting point. I mean, we have viewed gold as a core holding since the start of this year, and I think that's a view that very much remains valid. It's worth reminding ourselves at this point that we see bond yields and the dollar, besides safe haven demand, of course, as the key drivers of gold. And that's where an environment of rising yields does make an environment much more difficult for gold, because as yields go up, whether in nominal or inflation adjusted terms, that does raise the opportunity cost for gold, which ultimately is an asset class that doesn't offer a yield. Now, we do expect a limit to that, if the Fed sort of prevents a runaway rise in yields, but we do find it difficult to make a case that, falling bond yields will be a driver of gold from here. Instead, we go back to focusing on the resumption of long-term dollar weakness, because we do think, looking beyond any corrective bounce, that could pick up the baiting and drive further absolute gains in gold. But of course, that may not be something that comes immediately, particularly as near-term technicals for gold do look a little bit weak. So I think where it sort of nets out is that looking beyond sort of any near-term weakness, I think gold does remain a useful portfolio diversifier. So it's something we consider keeping an allocation, but it's worth having the conversation to see, what's the right amount for each sort of investor to the extent of what we view as a core holding.
Thank you, Manpreet and Abhilash, for joining our conversation today. That is all the time we have for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please go to marketinsights@st.com. As a reminder, if you have enjoyed our insights, please rate and review us wherever you get your podcasts from. Now, for clients of Standard Chartered, you can check out the SC Private Banking app or reach out to your relationship manager if you would like a copy of our publications. Thanks for joining us, and we will catch you next time on Standard Chartered Money Insights.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.